Welcome, Maverick Traders, to our Psychology Corner, and today it is recency bias. Once again, it is a bias, and what is recency bias? Well, recent occurrences and the bias that they create. As always, look at putting these things into your trading plan. You might be more susceptible to one bias over another, but literally, as a trader, you should try to recognize if any of these biases are at play in your life. Do you struggle with any of them? If you do, it needs to be in your trading plan. You need to recognize it. I personally have some biases. I do. I fully recognize that. I've put things in my plan where when I have these feelings, I catch myself and I go and I question, okay, is this one of those times where I have this tendency to feel a certain way, and actually it tells me to do the opposite, right? It kind of tells me, hey, avoid this situation. So what's recency bias? Well, a little background again, it's a cognitive bias that favors recent events over historic ones. It says whatever's happening right now, well, that's what's always going to happen, right? It convinces us when there's a rising market or stock or a falling one that it's guaranteed to continue. Hey, this is the way it works. This is how it works. We'll find that a lot of brand new traders will come in with just this crazy conviction because the only thing they've ever seen and experienced is recent events. So imagine your first experience trading was from about March of last year during COVID until now, right? It would be like, well, you think stocks only go up and every dip is a buying opportunity, and you haven't even considered the fact that markets go into bearish trends for multiple years. It hasn't even crossed your mind because you've never experienced it. And so your belief in the markets is not one based off of true statistics that, hey, this is what happens 68% of the time, and this only happens 16% and 16%. No, this is not how you consider it. Your bias is based on recent events, which, by the way, are extremely bullish. So your picture of the world is entirely different from reality. And there's a lot of that going on in the markets where, like if I think about the crypto markets, there's extreme bullishness because a lot of people's only experience with crypto is of a rising market. And if it's really been a pretty much a rising market for the last, number of months and people are buying, well, what are they inclined to do? Wow, that felt good. I'm making money on this crypto. I'm going to go buy the next one. And I'm going to go buy this one. And all of a sudden, the risk taking ramps up. Now, if you get large groups of people, it's like a herd mentality, right? If you get the herd stampeding, of course, it will pressure prices that way. But believe you me, this will eventually turn back. And the question is, are they prepared for that? Are they expecting that this is the world and in reality, this is the statistics of what's going to happen, right? They are operating in an extreme bullish environment that cannot statistically last over the long term. Maybe they haven't even considered the risks, right? So you could change your plan based on recent outcomes. It's one of those things where can you tweak your plans? Sure, but you shouldn't look at a runaway bull market or bear market or this patterns that are working lately and kind of go full bore into that. Just about the time you're ready to ramp up, and you feel like this only happens. It only does this. I've seen it. I've seen it for 3 weeks, so I know what the future is going to do forever. Well, that gets you into problems because as you start to adjust, and this is where I think kind of crypto and various markets are, we're going to see some nasty declines people haven't even considered. I would imagine they're coming probably sooner rather than later. With recency bias, traders tend to put too much emphasis on recent events. So they're not thinking about, bull and bear market cycles and consolidations and normalcy. They're just the most recent events is what sticks in their mind, right? And that's their experience. So even if they've, you'll see this a lot with markets in that if you've experienced a bearish market, and really anyone that went through 2020, I don't even consider that because it only lasted a month. I'm talking, did you trade through, I traded through '08 and 2000 and so forth. If you traded through these markets, it was multi-year downturns of aggressive selling. But what's interesting is the same thing is true. As the market started to recover, it's not like everyone believed in it. This was just too recent. And so this just had this negative effect on people that's hard to shake off. If you live through a bear market, you're going to naturally feel skeptical and feel like the boogeyman's out there, right? These are the psychological tricks. Well, if you've lived through only these bull market cycles, you don't have fear of this, which can kind of be a good thing for right now, but when it happens, you might have way too much risk. This is why people get blown up. They over leverage and they take too much risk in a bull market cycle, not even considering that, look, the market will, I don't know when, but the stock market's going to go down 40%. I don't know if it's, next year or 10 years from now, but will the market lose 40% of its value? Absolutely. Will some cryptos go to zero? Sure, they will. That's going to happen. So people get sucked into and kind of put too much weight on recent price action. People start to become interested in something because it's going up, not because they understand it. It's the recency that appeals to them, right? If a market has struggled, it's part of why people are not, if you turn on CNBC, they'll do a special on Bitcoin. They probably don't even care about gold, right? Gold has done nothing for 10 years. Bitcoin has boomed. So you don't get eyeballs and you don't drive emotion by talking about how boring gold has been. You get excitement by saying, Bitcoin's booming. Look at this coin. Hey, somebody made $100 million because this guy bought 10,000 of it and held it for 3 weeks, and those are the things that drive clicks and get eyeballs. So people become interested in that, and that's what drives it. It's recent events that drives those animal spirits. As a trader, that's a very good thing because if we just look at the herd mentality, if you have a bull market, you want to trade in that market, in that direction. If somebody told me, this is going into a bubble, if you told me that whatever, let's say that, gold was going to go into some massive bubble, I'd say, well, trade gold to the upside, right? Get in the bubble. If you said crypto's in a bubble, I'd say, well, trade it to the upside, right? We're bubbling up. If you said technology is in a bubble, okay, trade it to the upside. When the bubble breaks, it's a different story, right? But we want to take advantage of the strong trends and the strong environment. So the S&P 500, when '08 hit, the pessimism has lasted for many years because everyone thought that recent experience was so traumatic that they felt like, well, we're going to go back to that, right? And instead, the market boomed. Bitcoin is booming, so everyone super optimistic. Perhaps, of course, we want to trade while you're in a bubble, but the question mark becomes when it starts to unravel, it can get really crazy and out of control. So you don't even have to predict the top. Once it starts to break down violently, there will be more and more selling. Some of it will be forced liquidations. That's where things really intensify on the downside. Futures prices turn negative. Oil literally went from the biggest of booms to the ultimate failure, where futures turn negative in price versus being positive. These are all examples of recency. So the pessimism from oil and commodities will linger on because they've been so bad, even though oil has really started to bounce sharply off of those lows. Back here, when everyone was optimistic, oh, by the way, that's because in '07, oil prices had boomed. So the recency of that caused them to be way too bullish in 2010, 2011, 2012, 13, because the most recent occurrence was gas prices skyrocketing, oil prices skyrocketing. So you had become conditioned to believe that that was always the way it was. So just ask yourself, when you're in those markets, understand that recent events are not really the best predictor of the future. You should really think about long-term history. To get an accurate picture, you want to think about the long-term history of an asset, more so than the short term. These can be creating extreme sentiment shifts. Avoid trading plan changes based on short-term results. Really think about the long term and genuinely ask yourself whether the current outcomes are most likely to be the future outcomes. If you look at it objectively and without bias, that's the way to go.